Get more on the banks with Chris Marinac. He's Director of Research at Janney Montgomery Scott. Chris, great to have you back. Nice to see
Thank
you. Any surprises to the upside or the downside? I guess there really were no downside surprises, but any surprises there?
I think you're going to see more buybacks. And I think on Tuesday, when the banks are free to discuss their share and capital returns, it'll be positive. The average bank in the stress test this year had a 3% decline in shares outstanding from the end of 23 through first quarter of this year. So it's more of the same and most likely higher. Wells Fargo had a 9% drop in share count while their asset cap was on. So now that that's relieved, they'll probably buy back less, but still be buying back shares. I do think that the results signal that the Fed is not only going to be accommodative in the banking industry, but it wants to spur the banks to lend. So the reality is bank loan demand is somewhat tepid. It's about 1.3 to 1.4% year to date. I think we'll see a little bit better second half as we have some uncertainty clear as we get into the fall. But more buybacks are good for stock prices. And I think we're still recovering from sort of the negativity that was a little bit excessive back in April.
Yeah, buybacks and dividends good for investors as well, Chris. And I'm just wondering, from the investor standpoint, banks have had a great little rally here. I mean, we've got the likes of a J.P. Morgan, for instance, at basically all-time highs at this point. And I'm wondering, how much of all that expectation of regulatory easing is already priced into these shares?
Well, some of it is, but if you even look at the KRE for a broader perspective, it trades about 10 to 10.2 times earnings today, and we were at 12.1 before Liberation Day. So I still think there's a comeback to happen. We haven't had earnings estimate cuts, which is good. I think we could see actually estimate increases as we process in buybacks, and also capital and credit costs could really be more positive than investors and analysts have thought. We don't see major credit shifts at all this quarter coming up. And I think overall, the bank's ability to weather the storm from credit issues down the road is still very great. The profitability this year has been higher because of net interest margins. If the Fed were to cut at a later time, that's going to be good for the deposit costs, which therefore will in turn, I think, improve earnings further.
Chris, Bonawyn here. Thanks for being with us. So I'm thinking back to March 23, roughly. Could you kind of give your thoughts on finding the fine balance between making sure that we have ample liquidity within the long-term Treasury market and treatment of those longer-term assets, particularly the hold-to-maturity Treasuries that kind of led to the conundrum in the first place?
Sure. So I think if we look at how rates have been through today, it's been a very de minimis mark to market. It's going to be flat to slightly down on interest rates as of today. That's not going to change the mark to market. What you have every year is about 10%, 12% of the portfolio is paying off because of the high percentage of residential mortgage backs. That's the predominant security that banks hold. It's less treasuries and more RMBS. However, I do think that the payoff of these old vintage from 2020 and 21 is going to get accelerated this year and into next year. So I think it's less of a problem. Banks' liquidity is actually higher today than it was pre-Silicon Valley and FRC failing. I think that there's probably too much liquidity in many banks' eyes. They'd like to see the Fed relieve them on the LCR, liquidity coverage ratio. That's probably coming in a few more months, in addition to what we had this week on the SLR. Trading securities for the big banks, that is getting better. I think it can still get even wider, but I think it's a progress that we're making with the rule changes that we just had in the past few days.
If you're going to buy banks today, Chris, would you buy the larger, higher quality banks, or would you go down the cap scale?
I would move down the cap scale because I think those stocks have not moved as much. It's been a very strong month of June for the large caps. So I think your mid cap and regional banks still have more to recover. I also think the earnings and the buybacks will be very strong for those companies as well, even though they're not part of the stress test today.